Financial markets are becoming more and more panicky about the situation both in Europe and also the US. I think it's the lack of a decision which is really concerning people. It's concerning them that for every day the politicians mull over what to do with Greece and also the European banks. It's another day where consumers decide not to purchase goods, a day when business people decide not to make investment decisions. And that is slowing economies at the moment, and if they allow this to go on too long, one wonders whether the slowdown is becoming more acute. It's certainly a warning that Ben Bernanke gave the markets this week. He was talking about significant downside risk to the US economy, and as a result of that, financial markets have gone into a little bit of a tailspin. We saw one of the biggest one-day falls on UK and US stock markets on Thursday. And it's brought it all the way back down to the bottom end of the trading range. I want to look at some charts which are demonstrating some of the stress that is in financial markets at the moment and the impacts this is having. I'm going to focus a little bit on commodities today, and we're going to start off with the chart of the CRB Index. This is the index which really summarises the position of a basket of commodities and also oil. And we can see here the chart has been in decline really since the sort of end of April period, where we had the earthquake in Japan beginning to impact on a soft period for the US economy. It was felt that it was a soft patch. That's certainly our feeling at the time, but you can see that it's now starting to turn lower and really sort of picking up on the warnings that have been coming from financial markets that we may be heading for a further slowdown in the economies, particularly looking into 2012. So the CRB index is coming under pressure, and if we break down to some of the key parts, I want to pull up copper. Copper being a very stable constituent of many manufacturing processes around the world, and this really has come under severe pressure in the last few days. There are some positive signals to mention about commodities. Clearly inflation around the world has been driven up by raw materials and commodities, and has been concerned that the demand that was coming from Asia for commodities was driving these prices up and really impacting very hard on the Western world. So to actually see some softness in commodity prices at the moment is to some extent taking some of the inflationary pressures away from the UK and the US markets. We're also seeing a similar situation in oil, which is a stimulant to the US economy. So we're in a complex game at the moment, and it's not necessary to say that every move is negative or positive. We can look through those situations. Just looking at some of the mining stocks that are clearly being severely impacted by these weaker commodity prices. I'm pulling up Rio Tinto here, that has dropped from £35–36 just 10 days ago to trade sub £30 at the moment, and similar situation with Billiton that has also come into some severe falls. These could be opportunities if commodity prices do bounce from here, and if we do see an announcement in the near term that demonstrates coordinated action towards stabilising economies and ensuring that we don't head into recession, I think you're going to see quite a big bounce in commodity stocks and an even bigger bounce in some of these mining stocks. So they're risky. It's a bit like, as we call it, catching a falling knife by trying to buy these stocks. But as I say, I do see a fairly big bounce in these if we do get some concerted action to stabilise economies. I want to also look at the currencies. We've seen some very big moves in currencies. The big safe haven trade is to move back into the dollar and away from almost every other asset class going. And this is the dollar basket, the dollar versus a number of other currencies. And just look at the way that the dollar is strengthening there at the moment. Versus most of the other currencies at the moment. It's moved very significantly against the euro. That to some extent is going to help German manufacturing. It makes it even more competitive than it has proved to be, and to some extent a stronger dollar does help mining stocks in terms of assisting, and certainly when we look at price falls in commodities, to some extent that has been offset by a higher currency there. So as I say, keeping a very firm eye on that. The pound in that environment is coming in for some pressure. There have been some quite sharp downgrades to UK growth that has been seen, and we've heard the Liberal Democrats this week at their conference talking about potentially a £5 billion stimulus to the economy here that will be required to try and offset some of the weakness we're seeing in the economy at the moment. So sterling, having been stable through much of this year, is now coming under some pressure against the dollar, and we're now trading down 154 versus 164. Think about some of the big international stocks that we have here that do have international earnings, and the translation effect on that should be a positive to some of our companies. Finally, I just want to end on three charts. You will have heard mentioned in the press about Operation Twist. This is what the Fed has come up with at the FOMC meeting this week. It involves selling $400 billion of very short-dated treasuries and ultimately buying $400 billion of long-dated equities. And the idea behind that is to really try and significantly drive down the cost of long-term borrowing. So these charts, I think, amply demonstrate the impact that that's beginning to have. These charts, the first chart here is a 2-year treasury. It demonstrates the yield that you would receive on a 2-year treasury at the moment. You can see that relatively is unchanged, but as we move into 10-year treasury, you can see yields are coming down on 10-year, and more noticeably in the 30-year, which is causing that. So really, the impact of Operation Twist already being felt in markets. The question mark is this going to be felt in the real economy to save it off from what looks like a slowing picture on the US economic scene?